The coronavirus pandemic has created one of the worst recessions the world's seen, well, at least since the 1930s depression. But interestingly, it was also shaping up to be one of the shortest downturns. Australia's economy was already showing signs of bouncing back, well, following a very deep contraction in the second quarter of 2020. But then the threat of a second wave of coronavirus hit us. So what would a serious second wave of coronavirus do to our economy and to our housing markets? That's what I want to discuss with you today. Now, our economy seemed to be picking up, as I said, and most economists believed that our economic growth was going to be strong in the second half of 2020, well, at least improving, and in the absence of further widespread lockdowns, was going to do well in the end of this year and into next year. Now, while I'm optimistic about the future, and you'd know that from listening to my podcasts, I also realise that there are going to be some long-lasting scars. I realise that underemployment and unemployment are going to take years to return to pre-coronavirus levels. But I also realise that in response to the coronavirus-triggered financial crisis, central banks like the Reserve Bank, the US Federal Reserve also, slashed interest rates, it bought bonds, it helped finance businesses, it freed up cash, it gave support mechanisms to landlords and tenants. And this quick effort of central banks shortened the financial crisis to only a few months. But as I said, the scars are going to be deep. I'm sure they're going to be brief, but the side effects, the scars are going to last for a couple of years. Australia's going to have to contend with the loss of tourism, loss of educational exports. Clearly, our borders are going to be closed for a while, and that's also going to impact on our immigration. This means our economy is going to grow more slowly this year and next year. But a significant second wave of coronavirus will do damage. It'll do damage to consumer confidence. It'll slow everything down again. So today I'm going to explain my thoughts about this, and I'd also like to share an important message from one of my mentors, Jim Rowan. He's going to talk to you about winter. Now, I know we're going through winter, but not that sort of winter. He also explains that after every winter, spring follows. So I tell you what, I'm going to put my money on the fact that spring is going to follow this economic winter as well. Welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
Our property markets have been remarkably resilient so far. But how would a second wave of coronavirus affect our housing markets? Well, if we look back, there are some lessons we can learn to help us better understand what's ahead. In spite of the coronavirus-induced economic downturn, when you look back over the last year, Australia's property values didn't crash like the doomsayers predicted, did they? And our economy rebounded much more quickly than expected. And that was on the back of the fact that Australia, well, other than Victoria, has done very well in containing the virus, up to date. Clearly, the significant financial stimulus and support measures provided by our governments, they've kept the doors of many local businesses open, kept many people in their jobs, and at the same time, rental relief packages have kept tenants in their homes, and mortgage supports meant that there have been very few forced mortgagee sales. However, home buyers and sellers, they went on strike in April. They chose to postpone their next move until more certainty returned to the market. And this actually caused property transaction numbers to drop by 32.4% in April. But then, as social distancing measures eased, consumer confidence returned, and property transaction numbers experienced a really strong recovery in May and June. In fact, as I said in the introduction, it looked like we were going to experience a really deep but short economic recession. And it also looked like our property markets would weather the storm, defying, those predictions of 20%, 30% falls in values. But if Australia is hit by a significant second wave of coronavirus cases, that would postpone Australia's economic recovery, and it would mean unemployment would rise further, consumer confidence and business confidence would take a significant hit. So what's ahead? Of course, no one really knows what's going to happen to property values, so if they tell you they do, run away, don't listen. But it is important to analyse and anticipate possibilities and probabilities. How our markets would be affected by a second wave would really depend on how rapidly the health issues come under control, how quickly businesses resume normal trading, how soon our economy picks up, and most importantly, how quickly consumer confidence rebounds. Not surprisingly, there's a strong relationship between how people feel about their finances and their job security, and then with the financial decisions that they make. And this in turn flows through to how our economy is going to recover and how our property markets are going to perform. When we feel confident about our financial circumstances, we're more likely to feel safe making significant financial commitments, like buying a new home, like investing in property. However, a significant second wave of coronavirus, and then the continuing barrage of negative news that's going to come if that occurs, news about our health, our unemployment, and the businesses going bust, that's likely to dampen consumer confidence even further. It'll have a negative impact on our property markets also. But if a second wave does overtake us, I think we can expect further government support. The government and the Reserve Bank have clearly stated they're going to do anything and everything they can to support our economy and to minimise the impact of the coronavirus on our businesses and our economy. I can't see the government, which has spent so much time, money, effort and publicity building a bridge to get us across the line, not extend that bridge further until we get over the second wave. They're not going to allow us to fall off a cliff once we get there either. So what about property values? Well, if a second wave of coronavirus does cause further lockdowns or more social distancing restrictions, obviously our property markets are going to slow down, just like they did in March and April. But both buyers and sellers, they're going to slow down. They're going to go on strike till the picture becomes clearer, just like they did earlier this year. But similarly, like earlier this year, property values won't plummet because it's unlikely there's going to be a flood of properties for sale. So for property values to plummet like some people were predicting, you don't hear them as much anymore, but for property values to plummet, you're going to need people who have to sell and they can't find any buyers so they'll sell at any price. That's unlikely to happen. Of course, there's not one property market in Australia, and during difficult times, there's always a flight to quality. That means A-grade homes, investment-grade properties in our capital cities and our major markets, our major regional markets also, are likely to hold their values well. They're going to fall a little bit, maybe 5%. In the meantime, B-grade properties, secondary properties, they're likely to fall much more, over 10%. And C-grade properties, well, they're going to be difficult to move at any price. So yes, overall, our property markets will fall further, especially if we get that significant second wave, but not all properties are going to fall. Interestingly, only a couple of days ago, I was speaking with Trevor, a client who's instructed my team at Metropole to find him a development site in Melbourne. He's a successful business owner, he's got good income, and he's adding to his property portfolio. And what we normally do is buy old homes close to their use-by date, pull them down, and actually manage the whole development process run by my son, Bryce Yardney, director of our project management division. But Trevor asked me, well, maybe I should wait a while. What's going to happen to the value of these sort of properties if there is a second wave here in Melbourne? Now, I reminded him the sort of property he was buying was an old home past its use-by date in a great position because we're going to pull it down in a couple of years' time when we do the development. So I said to him, think about it. The person who owns that home, they probably bought it 20, 30, 40 years ago. They probably paid a couple $100,000. It's worth a couple of $1 million today. They don't even have a mortgage against it or very little mortgage. That sort of property is not the sort that's going to decrease in value. Similarly, other properties around it in that area where most more affluent people are living, they've got their jobs. They've bought their properties 10, 15 years ago. They've probably paid off half their mortgage. That's not the sort of area where property values are going to drop. But there are other areas where property values are going to fall, and I'll discuss that with you in just a moment. But overall, I see a continuing of low level of transactions. But if there is a second wave of coronavirus, the pace of recovery of the property market and the economy, that's going to clearly slow down. See, at the moment I'm seeing three levels of property buyer sentiment out there. There are still the negative Nellies, the ones who are worried about property prices. They think they're going to crash. They're talking about doom and gloom. But they've always been out there. And over the long term, they've always been wrong. Currently, there's a whole heap of them following me on YouTube, faceless, nameless people who are hoping the property market's going to crash. Of course, the majority of Australians, the second group, are basically bunkering down. They've battened the hatches. They're just waiting for the news of all this to go over. Now, last time round, they're the ones who went and bought the pasta and the toilet paper and the noodles and stored it away. At the moment, they're hoping it's all going to go away. When it does, they're going to get back on with life again. But they're going to miss out some great opportunities. And the third group of people I'm currently seeing are those with a positive outlook. Most of those have got a secure job, but they've got a long-term focus, and they see great buying opportunities in the market at the moment when there's less competition and when interest rates are the lowest level they've been in history. Now, interestingly, investors are currently at the lowest level they've been in the market for a long, long time. Normally, investors make up 30% and boom times 40, 50% of property transactions. Currently, investor loans are at about 20%, just above 20% of all the loans. The last time the Australian Bureau of Statistics showed us finance figures. At the same time, though, first-home buyers are out there taking advantage of the government grants, the home builder allowances and the prevailing low interest rates, and they're getting a foot on the property ladder. And this trend's likely to continue. Now, some of them are going to get it wrong because, unfortunately, they think these home builder allowances are for them. They're not. They're for the builder to keep the construction industry going. So they're paying too much and buying in the wrong place. Certain segments of the residential property market are going to be affected, though. Apartments in high-rise towers, in fact, those properties were never going to be particularly good investments anyway, but they'll be out of favour for a while for investors and home buyers. Off-the-plan properties, poor quality investment stock, as opposed to investment grade, poor quality investment stock apartments, they're going to also suffer, particularly those in the CBD and close to the universities, where currently there are huge vacancy rates. Now, in the outer suburbs, house and land packages that people bought a year or two ago, where young families often overextended themselves financially, those areas are going to suffer a bit and property values are going to drop as well. In those areas, many people are going to be out of work for a while or financially strapped. The problem is there's not many people to sell those 1 or 2 year old houses to because there's another house and land package, there's another estate in the next street, and young people are more keen to pay more for the new properties, and investors, not that they should be buying out there, buying the new properties because of the depreciation allowance. So there's going to be some young families who are financially strapped, some investors who bought off the plan who are not going to be able to settle because valuations are too low, and some investors who own properties in apartment towers who are going to have troubles, and then some blue-collar areas are also going to suffer a little bit moving forward. On the positive side, households and property investors whose incomes remain stable and secure, they're going to be able to take advantage of the property markets and buy properties at historically low interest rates. And in the medium term, this should support stronger level of price growth. What's going to happen to our economy, though? Yes, the health crisis has led to an economic shutdown, and some people were concerned that this had the potential to create a major financial meltdown, not just in Australia but around the world. Clearly, that hasn't happened. Now, sure, there have been some setbacks, but as our economy reopens, obstacles like the outbreak of COVID-19 in Melbourne, these can be expected. They always were on the cards. Of course, a serious second wave of infection, that's going to delay the economic recovery, it's going to increase unemployment, and it's going to dampen consumer and business confidence. Unfortunately, there's no roadmap to follow, so our governments are going to need to respond quickly to any change in circumstances. But most of the bright folks I've been following, the ones I've been talking with, they all agree Australia's better positioned than any other country in the world to work its way through the challenges ahead. And these include the economists from our major banks, our institutions, as well as the economists at the Reserve Bank and the International Monetary Fund. They all agree Australia's going to quickly pull out of the recession, but it's not going to have a V-shaped recovery. Not like what happened after the global financial crisis. Because this time around we don't have China out there taking all our exports, buying our real estate and supporting our economy, do we? It looks like we're going to have a stepwise recovery as our economy opens up in stages. Now, the economic results for the June quarter, the second quarter of 2020, that one was just over because we're now into the third quarter, that's only going to be reported in September. And it's going to tell us that we experienced a severe recessionary period. But by the time these results are reported, it's likely that our economy is already going to be on the rebound. Businesses are going to be open, more jobs are being created. Now, the second wave, this new outbreak of coronavirus in Melbourne and Sydney, that's made Aussies more nervous. This means they're going to be more likely to be cautious spending, especially on big ticket items. However, to make up for the hassles and stresses they're experiencing, they're more likely to spend money on entertainment and on pleasure, and this is going to help our local retail markets. And with our international borders closed for the foreseeable future, the millions of Australians who would have otherwise travelled overseas, gone on vacation overseas, they're going to vacation locally, and that's going to help boost our local tourism industry. In fact, we're already seeing signs of that in Queensland and Western Australia. That's good for our economy. Now, I know some of the support mechanisms are going to be taken away at the end of September, with JobKeeper and mortgage holidays planned to be ended, but the government's going to replace them with other more targeted stimulus packages. Our government's got a vested interest in keeping the real estate markets liquid and buoyant. They recognise that consumer confidence is critical for our economic recovery, and they also know that the quickest way to see consumer confidence plummeting is for people to see the value of their homes dropping. So it's likely we're going to see new targeted support packages rolled out over the rest of the year, and some of these are going to be announced on July 23rd in the mini-budget. At the same time, our banks, they've got a vested interest in supporting our property markets as well. Now, I know some people are calling it a Ponzi scheme. No, it's not, because the banks are well capitalised, they're sound, and they've been lending money to the people who can best afford it. And they're not keen to turf their clients out on the street. So what else is likely to happen if we get a second wave of coronavirus, a significant one? Well, it's been said that up to 3 million Australians have changed their living habits because of COVID-19. We know that many young people have moved back home with their parents. Well, this trend's likely to continue. That's going to mean that our rental market will continue to languish. There's going to be fewer people seeking rental accommodation at a time when vacancy rates, particularly in our CBDs, particularly around the universities and in the close to CBD suburbs, but the vacancy rates there are going to be and remain high. At the same time, another thing I think you've got to be aware of is that the banks are going to remain vigilant. They're going to carefully scrutinise all loan applications. Now, if you're looking to refinance, and this is a good time to consider that, they're going to look at you very carefully. And if you're looking to get a new loan, be prepared for much longer processing delays and be prepared to answer a number of round of questions. So have all your paperwork ready, because they're going to look at you very carefully. But again, this is good because it means those people who are borrowing are going to be the ones who can afford to, and that's supportive of our banking system, our economy, and our property markets. At the same time, our banks are likely to offer further extensions of repayment holidays to give those borrowers who've got some cash flow issues some more breathing space. Based on my perspective, having been involved in the property markets for close to 50 years, I believe the impact of the coronavirus pandemic and even a second wave on our property markets will ultimately be temporary. Sure, in the short term, it's going to hurt, and for some people it's going to hurt badly. Now, I know this view is different from what others are forecasting. Remember, some are still suggesting property values are going to fall significantly, but the ones who had the outlandish suggestions of 20-30% downturn, they seem to have disappeared. Remember, property's resilient. It's very different to the more volatile share market. Remember, most properties still lived in. In other words, people get rid of other luxuries before they sell off their property, especially their home. So if you're one of the lucky ones, somebody who's still financially secure, why not consider this as a good opportunity to upgrade your home or buy your next investment property? One of the major lessons I've learned from previous downturns is the importance of taking a long-term perspective. That's always going to outsmart short-term reactive thinking. For mine, it's always the property fundamentals that really matter, that drive our markets in the long term. Things like demographics, supply and demand, affordability, the availability of finance, and local economic trends. Now, of course, we know the old saying, be fearful when others are greedy, and be greedy when others are fearful. But it's normal human nature to find it difficult to buy a new home, or to invest in a property when everyone else is running around thinking the world's coming to an end. However, now that I've invested in 8 property cycles, I've found that's exactly these sort of conditions, the ones we've got at present, that give you the best buying opportunities. This means now's the time to get prepared to take advantage of the opportunities the market will offer, if you're financially sound. I know that after each global disruption, there's been an increase in property values, and there's no reason to suggest this will be any different this time round, because as I mentioned, the fundamentals are still strong. We went into this economic downturn, which created a property downturn, not because our economy was so bad. Sure, it was faltering a bit, but it wasn't bad, and we hadn't had a large excess that normally leads to a downturn, neither in economic growth or in property growth. Remember, property values are not much higher than they were in 2017. We had a couple of slower years in our property market. So this downturn has been caused by the government, engineered by the government to stop a health problem, not because of an economic problem. So the underlying fundamentals are still good. In my opinion, for those who've got a secure job and their finances are sound or can be organised, this is, as I said, a great time to consider upgrading your home or buying an investment property. And when you look back, you're going to think, hey, it was. You see, it's human nature, though, for most would-be buyers to sit on the sideline for a while, to wait until things are more clear, till somebody rings the bell. Now, we know nobody does that. That means there's fewer buyers, and those who do have to sell will be out there wanting to accept offers. So remember, don't make long-term decisions like buying a home or buying an investment property based on the last 30 minutes of news. There's no doubt there are going to be some opportunities for those who are willing to go against the crowd, and when they look back in a year's time, and definitely in 5 years' time, and particularly in 10 years' time, they're going to remember the unprecedented events of 2020. You're never going to forget 2020, but you're also going to remember that there were some great opportunities for buying properties there. Now, I know it doesn't necessarily seem it at the time now, but if you look back to the global financial crisis, that's how people felt then, and previous recessions and the Asian financial crisis and all the downturns we've had before. That's why if you want to move forward, you really need to have somebody on your team that's got the perspective of having lived through, invested through successfully a number of downturns. So I believe you need more than a buyer's agent. I believe you need more than a property strategist. You need a team with a holistic approach that can bring all the bits together to give you more direction, more certainty, and give you wealth-producing results in these challenging times. Hey, that's what my team at Metropole specialises in. We've got 60 professionals in 3 offices who provide strategic property advice. We give our clients direction and certainty and clarity by putting together a strategic property plan for them. Others use our buyer's agency services, property management, property renovations, property development. Of course, we've got wealth advisory, financial planning, construction. There's a whole range of services. You could use some, you could use all. I don't know what your requirements are, but why don't you go to metropole.com.au, find out about what we do, and let my team and I be part of your wealth creation journey. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I hate to start off by repeating what so many other people are saying, but clearly we live in unprecedented and challenging times. But despite all the bad news in the media, there's also good news out there if you go looking for it. Of course, there's no doubt that there's still lots of many challenges ahead of us. We've got that triple whammy of the world pandemic, a recession, political and social unrest. So it's easy to forget the good times we experienced not that long ago. It's easy to forget that this phase is just another normal part of the economic cycle, the property cycle. Sure, the conditions that are creating a pandemic and creating deaths and illness, they're not typical or normal, but the fact that the economy and the property moves in cycles is normal. The fact that something goes wrong once every decade, unfortunately that is normal if you look back. Sure, we're in the winter of the cycle, but just like in nature, spring follows winter. It has for tens of thousands of years, and I'm prepared to put my money on the fact that it's going to happen again this time. Now, I came across a story from one of my early mentors recently, the late Jim Rohn, and that puts all this into perspective. He basically said that if you change yourself, you can change your life. Jim Rohn said life's about constant, predictable patterns of change, and the only constant factor is our feelings and our attitudes towards life. We as human beings have got the power of our own attitude, and that attitude determines our choices, and the choices determine the results. You've heard me say that before. Our thoughts lead to our feelings lead to our actions lead to our results. All that we are and all that we can become has indeed been left to us to decide and interpret through our attitude and choices, said Jim Rohn. He said life is like the changing seasons. You can't change the seasons, but you can change yourself. So the first major lesson in life to learn is how to handle the winters, said Jim Rohn. They come regularly, right after autumn. Some are long, some are short, some are difficult, some are easy, but they always come right after autumn. That's not going to change. And there are all kinds of winters. The winter in where you can't figure it out. The winter where everything seems to go wrong. There are economic winters, social winters, and personal winters. Jim Rohn said winter time can bring disappointment, and disappointment is common to all of us. So you must learn how to handle the winters, said Jim Rohn. You must learn how to handle difficulty. It always comes after opportunity. That's never going to change. The big question is, what do you do about winter? You can't just pull those months out of the calendar, can you? But here is what you can do. You can get stronger. You can get wiser. You can get better. Remember that trio of words: stronger, wiser, better. The winters won't change, but you can. Before I understood this, I used to wish there was summer when it was winter. When things are difficult, I wish they were easier. I didn't know better. And then I learned from my mentor, Jim Rohn. This was part of his unique philosophy. Don't wish it were easier. Wish you were better. Don't wish for fewer problems. Wish for more skills. Don't wish for less challenge. Wish for more wisdom. That was another great lesson from Jim Rohn. Well, hopefully now you've got a slightly better idea of what may happen if we get a serious second wave of coronavirus. And if you believe it's given you a bit more clarity and you know somebody else who'd get some benefit from this, please let them know about the Michael Yardney podcast. It's one of the ways our audience keeps growing. And my mission is to make as many people financially fluent, more successful in their life, and become better investors. And I'd love you to help me. Just tell somebody about this or use the share button on the podcast app. Now, if you want to tell the world, why not leave a review on iTunes or wherever you listen to this? And if I read it out, as I'm about to for Luke Moore in just a moment, I'd be happy to gift you one of my books as a way of saying thank you. Now, Luke left a lovely message on Apple Podcasts just recently saying, Michael Yardney, Property Dalai Lama. Now, I don't think anyone else has said that, but thanks for the 5-star review, Luke. He said, Michael Yardney is the calm voice of reason in the sea of chaos. Straightforward, common sense information, up-to-date data to empower and educate in property investment. This guy gives back to the people, and we thank him for it. Keep up the great work. Well, thank you. I really appreciate that, Luke. And if you email me, michael@metropole.com.au, I'd love to gift you one of my books as a way of saying thank you. Now, I'll be back twice a week with information to help you become more successful in property, in money, in life in general. But in between, you can catch up with me through social media. Just look for Michael Yardney or with my daily property update newsletter. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?